Welcome back to the Bitcoin podcast. We are joined today by Stephen Perrenod. Stephen Perrenod is a physicist, author, Bitcoin researcher with deep expertise spanning astronomy, enterprise computing, and cryptocurrency economics. He holds a bachelor's degree in physics from MIT and a PhD in astronomy from Harvard. He's published books on cosmology and extragalactic astronomy. The first person with a background on this podcast of that nature, Stephen. His work on Bitcoin builds on a long career in high-performance computing with senior roles at Cray, SGI, and Sun Microsystems, which provides an unusually grounded perspective on mining, network dynamics, and the computational physics of proof of work, which is at the core of Bitcoin. And so Stephen has contributed original analyses on the power law in gold terms, the stability of scaling relationships across regimes, the differentiation between Bitcoin's laminar and turbulent phases, and portfolio allocation through the Cael optimization framework. And Stephen, we have taken great inspiration, to say the very least, in applying what you have done in Bitcoin and power law in gold Bitcoin to our world of agricultural commodities. So thank you for being with us today and welcome.
Well, thank you, Kimle. Thank you, Cael. Looking forward to the discussion.
So you said you have some slides. What do you have prepared for us today?
Okay, let's get into it. One of the things that is important is to think about time logarithmically. And, Bitcoin has its own native calendar. And I think right now the block number should be about, very close to 960,000, something like this number I'm showing right now. I just checked half an hour ago. If you take the log of that, it's 5.98. Very close to 6. So it just tells you how close we are getting to 1 billion block history for Bitcoin. So some celebration will be called for in less than a year. That's less than a year away. Okay, here's some agenda. I want to first talk about Bitcoin as a meta network and then talk about its autopoietic nature. That's a fancy word that means self-organizing, but I'll define it. And it's actually from that and really proof of work, which you just kind of mentioned in passing, that you can get to a monetary standard with Bitcoin. And mostly I'll talk about scale invariance. And we have two types of scale invariance that we see in Bitcoin. Many people are familiar with the power law. That's continuous scale invariance. And over the past year, we've been uncovering, and some work earlier on, but particularly in the past year, we've been uncovering the discrete scale invariance that actually is kind of a partner to the power. If you have continuous scale invariance, you can also get discrete scale invariance in a system. I'll start with the power law. How does it arise? I'll note that there are about a dozen different methods that you can validate it. And I'll point out that we also have a power law in Bitcoin versus gold. You can do it in agricultural commodities. I think it's been done for wheat. I don't know what the index is, but it has been done.
We did corn.
Okay. And what exponent did you find?
5.04.
0.04. Okay. Corn does a bit better than gold. That's interesting. There's something called the affine test, which is the test of the fundamental geometry. And I've been doing a lot of geometry work lately on Bitcoin network that I'm not going to get into here because it gets complicated fast. I want people to get the power law and discrete scale invariance, which is log periodicity. Some grounding in that first. I'll talk about an analog with relativity, the idea that time slows, that we have to think in logarithmic time. And this is why we often will plot log price versus log age. There will be some intermediate price projection with the model that includes both the power law and this discrete scale invariance or log periodicity. I'll talk a bit about how they're coupled together. There's actually a hidden variable And then I'll show an alternative proposal that somebody made recently. A researcher in Portugal said, well, I can outperform using waves of sigmoid functions. The only problem is he has 10 parameters. So I'll go through that and show why a simpler model is better. And then I'll just close by saying our disciplines are complexity economics and econophysics. And I'll talk a bit about the Scientific Bitcoin Institute that we formed at the beginning of the year. All right, this is a diagram of the meta network or the ecosystem of Bitcoin. And depending on how you count, there are either 12 or 13 constituent networks. The number of blocks here is 13, and the list, it combined two of them. Or combined together, although probably should be separate. But they're color-coded. So what's in green are the core native Bitcoin components, which are the protocol layer, the nodes, the mining network, and the ownership, the adoption. And all of those we can talk about as being endogenous. That's the endogenous meta network structure of Bitcoin, because we have a separate network for mining, we have a separate one for nodes, and we have, additional ones for exchanges and so forth. Then at the top, we have the red colored boxes. That's the exogenous world. That's TradFi. That's everything from central banks to the banking system to the energy network to the semiconductor network and so forth, and geopolitics, everything into the global macro system. So those things are exogenous. Then we have all these things that are sort of interfaces, which are hybrid. And so there's connectivity between the exogenous external world and the internal endogenous structure of Bitcoin. And the point I want to make here is that the endogenous structure of Bitcoin is very strong. But these interfaces in blue are things like the exchanges, the second layers, lightning or side layers, other details of the user adoption network, developers, applications, people that develop wallets, and even solutions would be part of this, this set of hybrid functionality, since it's going to work between both worlds. The derivatives networks, the ETFs, and so forth. Now, out of these 12 or 13 networks, the thing to point out is that 5 of them are endogenous. So really a lot of what's going on is defined. Bitcoin develops from a protocol, and then you get to mining, and then that allows you to start building consensus because you have nodes. And then once you get to a certain level, you start building more and more security, and then you have the feedback loop. So there are many feedback loops in this meta network as well.
So I love the protocol. Just thinking about protocols from a couple different perspectives, it gives me, I've been around for a long time, but it gives me a flashback to 1993 when somebody told me I should get on this thing called the internet that I had not heard of. Well, I had to learn how to install TCP/IP on my personal computer at my place of work in order to use the Mosaic browser that came out of the University of Illinois. Anyway, the internet is a protocol, or like the English language or any language as a protocol, a set of rules that we may not even understand or sort of out there, but we agree to them through use. So I just love that. And I love the idea of the connecting lines, Stephen, that you have here too, whether it's, so we have our customers at Bitcoin, for example, running nodes. And so they will at any one time be connected to 10 to 12 other Bitcoin nodes that are part of that protocol.
Right. Well, certainly Bitcoin is money by the internet, and it is a foundational protocol in the way that TCP/IP is foundational protocol for the internet. We get an extra boost because the equation that goes to value is a little cleaner than you have for the internet. Creation with the internet is all sort of externality. It's sort of like blue boxes and red boxes in this diagram. Whereas with Bitcoin, the value starts being created directly inside the network. It's integral, it's endogenous to the network. It creates its own coins, its own money, which the internet did not. It was something that was left as an open, thing for the future. And Bitcoin is what's supplying that. So because we have this kind of self-organizing nature or autopoietic nature, we get emergent properties. The power law growth and even the log periodic cycles are emergent properties that come out of this sequence of having a protocol, building consensus, building security. And once you have that level of security, then you can get price realization. You can get monetary value being realized. And of course, proof of work is the critical element of the protocol. There are other very important things like the difficulty adjustment that keeps everything synchronized. But there was a long history to develop proof of work. It started at IBM Research Labs in Omaha, in San Jose, with Dwork and Nauer. And it wasn't called that. It was basically trying to fight spam. So they were trying to force a sender of an email to do work. And that's like applying a postage stamp. It's saying, okay, if I'm the receiver, I'm not going to open this thing unless the postage stamp is on there, right? Adam Back called it cache, where he actually implemented a working version. But it was still one-time creation. It wasn't a coin yet. And it was also a centralized server. The term proof of work was not coined until 1999, later by these two gentlemen. And then Hal Finney made the really key step of making the proof of work reusable, RPOW. So instead of a postage stamp analogy, it becomes a coin. You could use it over and over. And in fact, with very low friction. So it becomes, a recirculating economy with low friction. It was still centralized at that point. And then Satoshi solved the problem of having decentralized consensus, solving the Byzantine generals problem as well, of course, as the double spending problem. And of course, for everything that goes into Bitcoin, there's about 4 decades of history once you fold all of the cryptographic techniques in.
So, Stephen, you mentioned the Byzantine generals problem, which is so central to this. Could you spend a couple minutes just explaining that to our audience? Because I'm guessing it will be new for a lot of them, or the first time they've heard of it, at least.
Well, the idea is if you're trying to sack Constantinople and you've got a few generals outside the walls of Constantinople, and they each have their own independent armies, and they cannot communicate with each other very effectively. I guess they had flags and flares, basically, or riders. But, they have these independent armies, and several of them are going to come into Constantinople from a different direction. And the problem is, what if one of the generals turns traitor? That gets bribed by, the authorities in Constantinople, and the other generals don't know. And so they may proceed with their attack, but they don't have sufficient force to then invade the city and take the walls. So that's the problem, is how do you synchronize when you cannot trust all the parties? So it's really trying to find a protocol that will create trust. And proof of work is that protocol implemented in the way Satoshi did that creates trust by having the consensus be around a one-time lottery, winner take all, that is secure against a 51% attack, which means you would have to have a majority of all the computing power in order to spend a coin twice. And that's a very expensive thing, because all you do is you're able to maybe reverse one block. And it turns out to be, from a game theory perspective, to be more productive if you have that much computing power to actually just create new blocks and earn rewards that way. Because you cannot unwind the chain. The chain is exponentially hardened because of the way that it's linked one block to the prior. And if you fake one to then go and try and fake the one earlier is exponentially harder. And so it rapidly becomes an impossible problem to solve.
Stephen, just for fun, you mentioned Satoshi. I like to ask this. Do you have an opinion on who you think Satoshi is?
I don't really.
Okay.
I like to say that Bitcoin is the first scientifically precise monetary standard in human history. And I also like to say that it's something that humanity has been in need of actually for centuries. And we've had standards for weights and measures over the years. We finally got a system, under Napoleon to have more precise standards with the meter and the kilogram and the second, and from an energy and power standpoint, the joule and the watt, which are just derived from those basic ones. And one could argue now that Bitcoin is a scientifically precise monetary standard. It's defined as absolutely finite, highly precise with 15 digits of accuracy. And it's also created from energy and math and game theory to ensure no tampering in the way that we've just discussed. So that's my argument for it being a monetary standard. I'm not the first one to make that case. Saifedean Ammous did in his book titled The Bitcoin Standard, now 8 years ago.
It is interesting how these things emerge. So I'm reading a book right now on Chicago and sort of the emergence of the Midwestern U.S. economy. And as rail lines came to Chicago, essentially the farms of the Midwest were built the way that they were so that they could ship to Chicago. Things like the Chicago Board of Trade emerged. But another interesting story that I just wasn't aware of was that time emerged. And so before the railroads, communities would essentially set their own time. And so noon was when the sun was at its highest point in the sky. And so Des Moines had a different noon or a different time than Chicago, than Davenport or whatever. Anyway, that did not work when you had railroads. You're trying to schedule things. And so in the 1880s, it was the railroads that set up the Eastern time zone, the Central time zone, the Mountain time zone, and the Pacific time zone. And the government, federal government, didn't officially do anything with time zones until like 1918.
Right. I mean, we're talking, 100 years after the metric system was introduced, right?
Yeah.
Yeah, it came much later. And of course, you needed the telegraph too.
Indeed.
How else could you synchronize? Okay.
Now we're finally getting to money.
Now this fancy word, autopoiesis. It's actually a newly coined word. It dates from 1972. It was introduced by cell biologists, both of whom have Harvard PhDs, but they're from Chile. And they noted that the cell is an autopoietic environment, which means it's self-organizing. It has an interface with the outside world. It takes in resources, but inside the cell walls, it kind of runs everything, according to its own rules and systems, and it manufactures proteins and so forth. And poiesis comes from the Greek word for creation and production. So the idea is auto-production, self-production, self-creation, self-organization. And Bitcoin satisfies these conditions because of its protocol, its absolute scarcity. There's no issuer, there's no foundation, there's no CDO or marketing department. Its securities and its values scale together. It's neutral. It's globally neutral. There's no government, organizing it. And in fact, it's got a monetary memory that's path dependent, which in fact is the power law. So once you have all of these things, the system kind of has closure on itself. That is, the self-organization kind of locks in. And I'll actually show you how we observe the lock. Yeah. The dollar is not this way because it relies all on externalities. Fiat is not this way. You need the Fed and the Treasury and policy committees and monetary committees. When you have big shocks like COVID or, the closure of the gold window in 1971, the regimes reset and get redefined. Doesn't have scaling law. I mean, it grows exponentially. If you look at M2, it basically doubles roughly once per decade. That's 7% compound growth on average. But it restructures under stress. It's not kind of self-annealing. Gold also doesn't satisfy, although more so than fiat, which is highly autopoietic, the opposite of auto. And gold is kind of in the middle, but it doesn't create its own monetary structure. It just sits there as an element. It doesn't really generate its own adoption except through culture, but it has to be assayed, refined, minted into coins, and the value of those coins is assigned by states and institutions and culture for the most part. It does not have endogenous scaling law. And in fact, its value also grows not as a parallel, but exponentially, roughly for the past 6,000 years.
So I've, in talking to lay audiences, and I'll let you critique me if you want, but for the reasons of that self-organizing nature of Bitcoin, I've described Bitcoin as the most natural form of money ever used by the human race, which I know, watching the reactions of our audience, sounds funny because it's a digital technology. But my point that I'm trying to make, and again, you can critique this if you will, is that it mimics things from nature, like cells, as you had mentioned, and the I'm trying out your word, Stephen, autopoiesis.
Yes, I fully agree. Bitcoin has no other use but as money, which is not the same with gold, right? Gold has a lot of industrial use and on and so forth. And a pure money is used only as a money. In information technology, we have this idea of interfaces between systems, and then you need to have some uniform rails and standards. And there were lots of different standards proposed for networking, but everyone had to end up settling on the open network as the ultimate interface because of the sort of purity of that design. Bitcoin is the same way. I call it money 3.0. Gold was 1.0, and you had earlier money, which was 0.x or whatever, with shells. Fiat 2.0, and I call Bitcoin, money 3.0 for the.
I love that.
This is a log candle chart. This is a candle chart like you've never seen before. The price is in log. It's the US dollar price in log terms for Bitcoin over its history. The age is in log terms, log 10. So when you see 1.0 on the x-axis, that's age 10. And each candle has a different width in linear time. Each candle is uniform in log of time, which means in linear terms, each one for this particular case is 25% longer. And so that's why I call it log, log, log. In this version with this resolution, you only have 11 candles, 9 out of 11, 2 red candles. But whether you use an OLS, ordinary least squares, or a QR, both of those regressions determined independently run right. So just with these 11 data points or ranges, you can see the continuous scale of variance, the power law nature of Bitcoin, because it's straight on a log-log chart. So when you have a straight line on a log-log chart, you have a power law. When you have a straight line on a log linear chart where the age or time is linear, you have an exponential.
And so the more green candles than red candles is just indicative of Bitcoin making its way up over the course of time.
Yeah, it's going up to the right. A 6-year-old can see that. And the slope is close to the 6th power, which we'll get to later. And actually, from this, you can then calculate the Cael criterion as well. You just say, it's 9/11ths minus 2/11ths divided by some number, which is the outperformance of the green candles and the red candles. So you get a high allocation. If you're willing to wait longer time. The last candle is a 3.7-year duration. But why a power law? Well, nature loves power laws. They're ubiquitous. Doesn't mean everything's a power law. The heights of human beings is a Gaussian, more or less. But the fundamental forces, of which there are 4 in nature, are all either pure power laws or power laws plus other components. Gravity and electromagnetism, in their first order description, squared, both of them. And then there are 2 nuclear forces, the strong and the weak, and they both have 1 over r squared terms. The weak force has a 1 over r reciprocal term. And the strong nuclear force has this very strong confining spring term, so the quarks can't break free from the protons. And of course, the weak force has exponential terms because it's about decay, so that's why it needs exponential terms. But it's also got those power law terms. And we see power laws in biochemistry. I won't go through the 7 listed here. And we see them in socioeconomic distributions, including, for example, the Perrenod law that we see for distributions of income and wealth, city populations, even the sizes of lakes, firm sizes. Now, stock returns, you don't see it in the returns overall, but in the tails, you will see some power law behavior in tails. And even in the way viruses spread, you can see now networks, communication and social networks tend to obey power laws, and there's a name for it. Robert Metcalfe noticed this. It's called Metcalfe's law. And it's essentially something like the square of the node. So in its pure form, it goes as a square of the number of nodes in the network. And the idea is, if you and I are on the network, that's got a certain value. But if we add Cael, the value goes up more than just the ratio of 3/2 because we can each call each other.
So human networks, like anything involving human interaction, is going to probably
human interaction.
Yeah, is going to follow a power law.
Bitcoin is a communication network and a social. So the generic form is n times n minus 1/2, where n is the number of users, and that's basically the n squared law. Now, you may observe less than 2 in practice because, people group into communities and so forth, and people in the U.S. are less likely to call somebody in China than somebody else in the U.S. So you build up some structure in the network that has hierarchy. And that actually turns out to be favorable in the case of Bitcoin. Now, the users or the adoption for Bitcoin has been observed to run as the cube of the age. So that's a T cubed kind of network. And what we've asserted in our paper, which is called basically the mechanical or mechanistic description of how Bitcoin develops, is that it's a combination of adoption growing roughly as the cube of Bitcoin's age, and then this Metcalfe's law, where you square that. Because value, what Metcalfe said, is that the value of the internet goes as a square of the number of users. It's a little hard to calculate the value of the internet. It's easier to calculate the value of Bitcoin, and I'll show you that indeed it adheres close to that. So the idea is the value goes as adoption squared, and if adoption goes as a cube, and you square T cubed, you get the 6th power of age. And in practice, we find a little bit less than that, but very close, 5.7 as the power law exponent. Here's another example of a socioeconomic power law. This is per capita energy on the y-axis. It's a log axis. And per capita GDP on the x-axis, which is also a log axis. And so the general trend is a straight line. The power law is 2/3. So the GDP per capita increases with the energy usage by roughly the 2/3 power. And you see all these squiggly lines because this is not a snapshot for a given year. This is actually over 3 decades where you're tracing the path of individual nations as they go, on this chart, tending upward and to the right for the most part, as the world has gotten both richer and energy consumption has gone up.
Well, this is a timely chart in a moment in time where in lots of communities, including the one where I live, Ames, Iowa, there's all kinds of protestations of data centers.
Mm-hmm.
And I get asking questions, but yeah, long term, our prosperity is tied to using more energy. So let's figure out a way to use more energy.
Yeah. It just depends on who's the water table.
Yes.
Yeah.
There are things to discuss.
Okay. We've shown that Bitcoin adheres to a power law by a dozen different methods. The typical ones you'll see are the regression methods. The top 2 on this list, OLS, ordinary least squares regression, and quantile regression. I'll show you a couple of others. In our paper, there were 4 key ones that we used, such as a random pair scaling test, and there was also a Bayesian test, which is not shown on this list. Why does this happen? Well, first of all, because Bitcoin's autopoietic, and as the network grows, it develops structure. And the way that structure grows, because it's autopoietic and because it has these feedback loops, and difficulty adjustment is really important here, but other feedback loops as well, it tends to develop endogenously and not be completely knocked around by the various, macroeconomic exogenous influences. And it does develop this structure of fatter nodes. So an exchange is a fatter node, or a treasury company is a fatter node, or an ETF is a fatter node in the system. And such nodes have many more connections than do you or I with our, And these fat nodes actually stabilize the network. And there's a formal mathematical name for this. It's called a Lambert-W process, where something that starts out exponentially, when it develops this kind of structure, can be constrained to follow a power law, which we also call continuous scale invariance. And you can measure that for Bitcoin, and it turns out to have, a high value of this W. This is a recent ordinary least squares regression. It goes as T to the 5.7 power, essentially. And yes, there's variability. This is a log-log chart. But the important thing to observe is that from less than 10 cents, when we got price discovery in the middle of 2010, to, having exceeded $100,000 late last year, that's a factor of a million. There's over a factor of a million on this chart, over 6 orders of magnitude. That's a pretty strong long-term progression in performance, and it's reflected in the R squared. I don't think it's shown here, but it's 0.96. It's 96% for these latest regressions. And again, the x-axis, the years are marked, but you see them getting closer and closer together. That's a logarithmic x-axis, so this is a log chart. Now, there's a very interesting little trick here with a beta parallel exponent of 5.68. You get a 10-bagger if you increase the age by 50%. So take today's age, multiply it by 1.5, and in our case, it's about another 8.75 years. You expect to have 10 times the price if we continue on this same parallel trend.
I find it interesting, too. I'm going to forget exactly who I was heard presenting this, but they dialed back, showed a regression like you are, Stephen, through today. But they dialed it back to 2016 and just did the regression on data from 2010 to 16. And it was a little bit different than today in terms of the exponent, but not very much. So even at that early stage, the power law regression had a very high R squared. I'm going to forget exactly what it was, but
yeah, I'll show you a chart that speaks to that. I've also regressed the realized count and done it per coin, so that it becomes a price. It's the realized market cap, but per coin that's available that has been minted as a function of time. And that's also a power law. It also has very high R squared. It's about 5.8. You expect it a little bit higher because it's reflecting the fact that coins were manufactured along the way. But the R squared is just as good, 0.965. And this sigma 1 over t to the 0.83 power is calculation of how the volatility has come down. And roughly as inverse power law close to the recipient. Again, a log chart, ordinary E-squared regression.
And in economics, not to get too nerdy on everybody here, but finding an R squared above 0.9 in any study of variables is a rare thing. And a R squared of 0.965 is rarefied territory.
It is very rarefied territory. It's almost as good as a trajectory, a rocket ship, right? Once you've stopped the burn. I was listening to a podcast by Michael Howell, who's a world expert on liquidity, and he was talking about his correlation between Bitcoin price and liquidity, and he was proud of the fact that his R squared was 0.3, so that's quite high for financial series.
Does Michael Howell run Cross-Border Capital? Is that?
Yes.
Okay, yeah. And so
good guy.
I quite often, in the short term, look at liquidity and Bitcoin's relationship to liquidity. I see if I can find a short-term impulse, because I have the vice of trying to trade on near-term time frames.
Well, I have looked at it, and I have found that the financial conditions index out of Chicago with Fed is much better.
Okay.
So I suggest that you take a look at that, particularly for shorter term, because that's a weekly series. And it's
Great.
almost coincident. It has a little bit of lead in it, actually, but not much. And it's got much more predictive contribution to R squared than liquidity.
So one of the things I really appreciate about your work is not only am I applying it to things that we want to do for Bitcoin, but I do trade quite a bit. And so it's good for me to red team myself with your work, because as you said, Bitcoin is much more endogenous than I believed. I was looking at business cycles before, and I was looking at liquidity and trying to game theory. All right, what's the Fed going to do when Kevin Warsh comes in? You don't need to do that. It can be so much more simple.
I will tell you, and I'm going to show you today, that first of all, 96% of this is explained by the power law, right?
Right.
The problem, of course, that makes us want to trade is that the volatility is high. But about half of the residual after you subtract the power law is due to the log periodicity, the discrete scale invariance.
Yeah.
Now, I have not looked at all these series, and there are so many macro influences, but I've looked at liquidity, I've looked at financial conditions, and I've looked at halvings, and they're all small contributions. Of the three of those, the financial conditions seems to be the best, particularly for the short-term time scale, where neither the power law nor the log periodicity have. Show you that too, if we have time. So this is from our paper, which is now published in the Elsevier Journal Nonlinear Science. So it's a peer-reviewed article, published, well-known scientific journal that's based in Europe. And these are our core regressions for adoption, for the Metcalfe scaling, and for the price power law. And by doing those first two independently, we can multiply the exponents together and we recover the price power law exponent, which becomes a kind of proof point of our thesis, which is the price power law arises from the combination of adoption growing as the cube of age and the Metcalfe scaling. What we measure for the adoption growth, and the proxy here is the number of addresses, non-zero balance addresses, and that grows is the 3.05 power. It has very high R squared, 0.97. The second one is the Metcalfe scaling. It's a little less than 2. It's 1.84. Again, very high R squared, 0.95. And you also see the SE is the standard error on the exponents, small relative to their values. And then you see the residuals as well. If you take those two and run the product of them, you get 5.6. And when we measure just the price power law directly with this particular data set, it was 5.69. Very close, within a percent or two. And even Metcalfe's law for networks is within 8% of beta square law. And of course, that 0.96 R squared that we just talked about. And the residual, if you don't allow for any decay in volatility, overall is 0.3 in log 10 price terms. And that's really a factor of 2 in either direction, and that's 1 sigma. So this is what people really need to get comfortable with, that, the price can double or can cut in half, and you're still in the sort of 1 sigma domain, which is 2/3 of your price coverage, your price points. And 2 sigma being roughly 95%, you're talking factors of 4 up and down. Now, fortunately for us, it's not symmetric. It tends to go up, more on the upside than it does on the downside. This is an affine connection test. It's a geometrical test. It's related to metrics, geometrical metrics. It's used in general relativity and other differential geometry. And what you do is you take the transform of the price by kind of running it in the inverse direction and treating it like a temporal coordinate by raising it to the 1 over beta power and varying beta. And then you see, when do you get the straight line, where's the best fit? And so you have these curves, you're testing the different values of beta. They're called K on the chart. And the best fit is 5.75. Again, it's a log-log chart. And then on the NSAT, we had a finer rate search. But then the overall R squared is shown in the right-hand chart, and you see how R squared rises as you increase the power law index and then it starts to flatten out, and you get the maximum value and the best fit around 5.75. So this test gives a similar R squared, and it gives a very similar exponent. So it's an independent way to, what you want to do is flatten a curve metric. Think about curved space-time. You want to, it's like the great circle of the globe when you want to travel by. Okay, this is the lock-in, and you mentioned 2016. What this is looking, if you do an ordinary least squared of price versus age, any given year, only looking backward in time. Well, during the first few years, there was a lot of variability. It had not locked in. And I talked about that it's self-organizing, autopoietic, that the network builds up, and then it builds these fat nodes, and it builds this structure, and it gets to a critical mass. And that's what we see happening here, is that the critical mass happened roughly between age 4 and age 6. And by age 6 or 7, we had locked into a parallel index close to 6, and it's been under 6, but close to 6 ever since 2016. So for a decade now. And the shaded band around the curve shows the uncertainty in the parallel exponent. You see that getting smaller and smaller as we get to the point where we are now. But it really hasn't changed much between, well, if you look at age 9, 5.77, and now it's 5.68. It's changed very little, despite the bubbles and troughs and crashes that we've had over the years.
So somebody might say if they got into Bitcoin, last fall and bought coins at $120,000 and are sitting today at $60,000, well, it can't be following any kind of a trend. But in fact, it does. It's following the same trend as it did, even with that drawdown of about 50%.
You need to look at the context of not a factor of 2, but the context of the factor of 1 million increase in price. Since, price discovery began. So when the volatility is high, you've got to take a long term. One of the things that we did for this paper to publish it and following suggestions from one of the reviewers was to run some statistical tests around stationarity. It's called in statistics. And I won't go through the names of all of these. Augmented Dickey-Fuller, Phillips-Perrenod, another one, KPSS. And I ran the test, Giovanni ran the test separately, we get the same results. You look at whether the log price is stationary or not over time, and you look at the changes in log price, like the daily changes in the conventional TradFi way of just looking at the percentage of delta log price day to day. Or you subtract out the power law and you look at the residuals of log price, which is the way we like to look at things. And what we find is that either method, the residuals are stationary, but of course the log price is not stationary because it's going up as a power law. So it's a very clean story. And there are 4 tests here, 3 that are shown in the table. Another test was the Engle-Granger test. And they all support a long run power law. Engle-Granger is just some time behaving kind of like I showed in that. Okay, this is the regression against gold. And so it's just a log chart of price measured in gold ounces. And when it started, it was only a few 10,000ths of an ounce of gold. When price discovery began, it's now around 17 ounces. Has not done that well in the past year or so. The volatility is a bit higher than you have with measuring against the dollar, but the power law is also quite high. It's a 5.2 index, and you find the same value essentially whether you want an ordinary least squares or whether you want a quantile regression. The median quantile regression is that red dashed line. And they're pretty similar. That's a 5.24. So when people ask, well, what about inflation, this takes out a lot of.
And so we track, Stephen, as part of what we do, what we call the corn Bitcoin price. So how many bushels of corn does it take to buy a Bitcoin? Today, that's around 15,000 bushels of corn at today's Bitcoin and corn price. Anyway, when I first saw your article on this, power law versus gold, I couldn't resist running the regression for corn Bitcoin. And so our exponent came out at 5.04. It was just really interesting. And then
It is interesting.
For the heck of it, because we think in commodity terms, right? We sell commodities in agriculture and we consume energy-based commodities to do what we do. Anyway, oil, copper, wheat, we looked at some other things, all right around that, just above 5 for an exponent. For our commodity engaged audience that's listening, what does this mean when commodities, whether it be gold or corn or anything else, follow an exponent in the power law of around 5?
Yeah. What does it mean? It means that those things are behaving as exponentials and we're behaving as a power law because we're still engaged in value discovery. And the reason is that people don't understand Bitcoin. I have this synopsis that 1% of people understand Bitcoin. That's a little bit low because, we have a higher percentage of that, at least in the US, that have adopted Bitcoin. But globally, it's sort of 1% of people understand Bitcoin. Of those, 1% understand the power law. And of those, 1% understand the law of periodicity, discrete scale invariance. So, and the reason is that I showed you that the adoption of Bitcoin has grown as the cube of its age. Well, that is a characteristic of the way viruses spread. It's viral spread. The adoption of Bitcoin is a mind virus or a meme virus. And it turns out that people do not really get orange pilled unless they know somebody who also has Bitcoin. As you know, the number of people you've talked to, it takes time before people decide to take the jump. And so it's always underpriced in terms of its ultimate direction. Our expectation is the adoption is going to continue to grow in the same way that the internet adoption grew. And internet grew as a power law until well into the 21st century when you reach saturation. And we're a long, long way from saturation.
One of my questions for you, Stephen, has been, given that you're in the academic community, I don't know how many economists you spoke to, for example, but what's the academic community's reaction to your work?
Well, I have not been in the academic community for a long time. I was in the supercomputer community and I wasn't dealing with economists in that community. I have a good friend here who was a business professor. He's now emeritus at a well-known university. And he and I have been talking about Bitcoin for 10 years. He's very well off, having made very nice stock investments in Buffett and others along the way. He's still not convinced. And, so I think that's a typical reaction, right? And his reaction is pretty much along the lines of, well, gosh, you've been right, but, what will the government do?
Right.
And as we've seen, as adoption grows, government regulation follows, right? And now the government regulations have become more and more favorable. It looks like the Clarity Act is about to be passed pretty soon here.
Right. I say quite often.
All the regulations are in place. I mean, even we've got a strategic Bitcoin reserve now. They haven't allocated additional funding to it, but that probably will happen too.
Yeah. One of the points I make to people when they say that is, well, governance is focused on a distribution of power, and they're not going to go against where new power is coming from. They have to adopt it in order to keep their own position.
Sure.
But,
I mean,
but Bitcoin, unlike gold, is much more difficult to confiscate, to regulate, and all of that. They can and probably will try. But Bitcoin, like maybe I aspirationally think about the American people, is slightly, if not mostly, ungovernable. So it's interesting to think about the implications of that over, Stephen, what you described as the long term.
yeah. Well, in the 19th century, there were private mints, minting gold coins, right? And they were circulating, more or less locally. But that was legal and allowed for some period of time. Because of the nature of gold, one can do. And eventually, the federal government wanted to standardize everything, understandably. But we've got here something that's a global monetary system, not tied to any state. And that means that nobody can take down the Bitcoin blockchain. It's going to keep chugging along. So we talked about log time, and there's an analogy with special relativity. The equation is not the same, but the idea is that, and you've heard about the twin paradox. If your twin brother, flies his spaceship at very high velocity, relativistic velocity, to Proxima Centauri and, comes back a couple of decades later, they're going to be younger than you because they experience less clock time. Even biologically, they don't age as quickly. Time stretches out for you, but not for them. So this idea of relative time, the same thing is true in general relativity around black holes as you approach an event horizon. And you may have heard the idea that if your butt falls into the black hole, you never see them go over the, because the light emission from them is slowing down. And so you just see them sort of fade away. You don't see them be captured by the black hole. So Bitcoin has got this effective clock slowing in terms of the price development with the scale. And actually, fortunately, that applies to the volatility as well. So it's true that the returns are slowing down. Right now, the return trajectory is about 38% per year, and it slows down a little bit each year. But the volatility is dropping in similar fashion as well. So it's kind of falling towards this maturity horizon. Here's a different way of showing moving averages, again in log space. And so log price, log age, but with the moving average, I calculated it's an adaptive moving average. So the duration of the moving average depends on the age of Bitcoin. So it's actually 25 weeks at 2 years, but it stretches out to 200 weeks at 16 years. And we know 200 weeks has been kind of a support area. So it's just kind of reinforcing this idea of trying to think in log time for Bitcoin. And you can show that in log space. And the right-hand chart, it's the same thing, but it's in log linear space. So you do see it curve over because that's linear dates there. Okay, now this other kind of scalar variance, DSI is discrete scalar variance, it's log periodicity. And it's often seen in systems that exhibit the continuous scalar variance of power law can also have this discrete scalar variance manifest. And my hypothesis here is that waves of capital impacting the network as you got new tiers coming in. Like first there was cyberpunks, and then there was some retail, and then there was some exchanges and hedge funds, and you get larger and larger tiers of capital, and they kind of come in waves. particularly in conjunction with bubbles. And as they impact, that kind of can help like ring an oscillation. It's as if you have if you have an aluminum cylinder and you tap it, it's got some fundamental frequencies. So there's an endogenous frequency, and that's our discrete scale invariance, but it happens in long time fashion. So it has this equation where the first term, A t to the beta, is the power law. And then if we put it all in log terms, which is the boldface, it's the first two terms of the power law. But then the last term that has a C in front of it, it has its own constant, but then it has this cosine term times the fundamental frequency, omega, times the log of the age. Here we use natural logs for convenience, plus phi is a phase. So it's got a frequency and a phase, and it happens in log time. And this is called log periodicity. And more generally, you can have harmonics, so you can have a sum of multiple of these final terms where you basically have some multiplier times the frequency. It could be integer, it could be non-integer. It's on the phase. Now, this frequency also ties to a parameter called lambda. That's shown on the left side at the bottom. The lambda equals exponential of 2 pi over. That is the spacing parameter. And it says in log time, peaks are going to be roughly spaced by that amount. And it turns out to be roughly 2. So it's basically saying that the bubbles are getting further and further apart, roughly by. Now, you can identify this by doing a Fourier transform on all the residuals. And here it's shown the power, which is on a log scale, versus the frequency cycles per long decade, which is a weird set of units. But you can convert that to angular frequency, and it works out to be 8.76 for the angular frequency. And then you can ask if there are harmonics. So the red line is the fundamental, and the green and blue lines are harmonics. And we don't really see very clean harmonics, but we see some harmonic structure. However, it's significantly down in power because this is a little log chart. And then when you convert that 8.76 frequency using that equation I showed you, it converts to a periodic spacing of 2.05, which is that. This parameter, too, locks in the same way that the power law exponent locked in. And it does it around the same time. So you can measure what it was in the early days, only looking backwards, and it increases and then it falls back. And it's been around 2 ever since age 6, ever since 2015. And it's been really not very different from its current value, a little bit over. And we measure these with different techniques. We get slightly different values, but they're always between basically 2.0 and 2.1. And this particular technique is like an FFT, but it corrects for the fact that you've got linear data that's not evenly spaced in log time. So you kind of convert it to log time first.
So Stephen, maybe doing just a little bit of interpretation of this.
Yes.
You're looking at residuals. So there's a power law trend price. Bitcoin can be above or below that, although more time above than below. But what you're saying is that difference follows a pattern of waves. So, and you say the word harmonic, so it makes me think of like sound,
Yes,
things like that. So like when you're sitting at a train intersection and he has this train siren blowing and goes by and you get that sound effect. Anyway, I'm probably not drawing the most perfect metaphor here, but that there are waves for how Bitcoin price moves above and below that trend price over the course of time.
this spacing parameter applies to the timing of when the bubbles happen and also when the troughs happen. And you get the same result, whether you measure the bubble peaks or the trough, but you also get the same result if you take all of the periodicity, all of that data, and in log time, fit it and find the fundamental frequency. And that fundamental frequency converts into a wavelength you're used to if you've had any engineering physics, and lambda is a wavelength for sound or light. But in this case, the wavelength is in log time. And so what it's saying is that that's the fundamental spacing for structure is like a factor of 2 in linear. So if the spacing between the first two bubbles was 2 years or 2.5 years, you'd expect the spacing for between the next two to be 4 to 5 years. That's what it's saying. And I'll show you, I think, a fit later on. This is another way of measuring it. You get essentially the same answer. It's called wavelets. You get the same kind of 8.76. And the yellow and green colors where you have the most power, where, the effect is coming out. And in the upper chart, it's in dollars, and the lower chart, it's in gold. So you see it in both dollars and gold. It tends to spread across the whole history, but it does kind of taper off in late years. It looks like some power's leaked up into harmonics. So if you look at that little chart in the lower left, that's kind of the effect that we're talking about. That's showing the power of this log periodicity, the amplitude of the wave as a function of age. And so I've got it in linear time here. So you see that the wave peaks are spreading out, the troughs are spreading out. And actually the amplitude is coming down because we know the amplitude is coming down. So I fit that to something that's similar to a fall of reciprocal of the age. And the last trough for the fundamental was in the middle of 2023, and the next peak is late 2029. So it's getting to be a longer and longer cycle. Can have harmonics, and that tends to complicate the picture a bit. And you need some harmonic to get a better explanation for what happened in 2021 in particular. But this value of around 2 is very typical in nature. We see it in earthquakes, in rock fracture, in fluid turbulence cascades. We see it in volcanic tremors. We see it in the tails of financial bubbles. We see it in population collapses and in ecologies, the study of animal and plant populations, predator prey. You see it in statistical physics, but 2 is a really typical value. So it fits well in sort of this kind of universal physics of log periodicity. This is showing how it works in practice to try and fit residuals, and showing with harmonics. So the orange line has the fundamental plus 1 harmonic. The green line has 2 harmonic, and so it fits a little more of the structure better, including a little mini bubble in 2019. The gray line in the background is just the log price residuals once we've taken the power law out over all history. The blue line is trying to fit a linear form, something similar to a halving, although it turns out the best fit is 3.5 years. But the power in that, the R squared explanation is much lower. It starts getting out of phase even by the 2013 bubble, and doesn't fit the 2011 bubble very well either. Although it did a reasonably good job in 2024 in catching that peak and the decline into 2026. We did not explain that very well do explain some of the pull down with, you see at the orange and green line, they were coming down. The rest of it, you'd have to ascribe to exogenous factors. Maybe we're explaining close to half of it. And then the right-hand chart is against gold, and you see something similar there. Qualitatively similar to what you see with against the dollar. And this has a little bit of a forecast out into Q2 of 2028 with either the 2 mode, a fundamental and 1 harmonic, or with 3 modes with 2 harmonics. in Q2 2028, you're up around $300,000. But remember, the volatility is a factor of 2 in either direction. If you allow for some decline in the volatility, one segment like a factor 1.6, but even that would put you in a range below 200,000 up to 500,000. And it does not include the effects of, the exogenous influences, which can work with you or against you. It's like you could be in resonance with the fundamental tone here, or you could be in constructive interference or destructive interference. How are we doing on time?
I'm good to keep going.
Okay. This is a comparison. There's a researcher in Portugal at the University of Porto and engineering background. I am going to try and wrap things up in the next 10 minutes because I do have a call in 10 minutes. And he put out an article, not in a journal, but in archive, saying that power law had weak structure and strong forecasts. I couldn't let that sit. So what he did, and I've been in contact with him. He's a nice guy, Carlos. We've had a lot of conversation back and forth. But he applied a multi-sigmoid and a degree 9 polynomial and a cubic B-spline. They all have 10 parameters. So he's able to get good fits, high R squared, and somewhat lower volatility with this really ad hoc multi-sigmoid decomposition. And this is showing his chart in the different components for that. But note the strong forecast, because then he did out of sample testing. So the smaller chart on the left is his chart. And it shows, in fact, that his model did not work when he took it out of sample. That a naive model was best up to 6 months, and that's the blue line. And the power law was best, and that's the red line. You want the line to be low on the chart with the smallest root mean square error. This is again log 10 pi, so you want low error. And the red line is the best. So from 6 months out to 24 months, he said, yeah, the power law is better for forecasting. And his 10 parameter multi-sigmoid just kept going up and up. It reached like 0.8 in log 10. Well, that's a factor 6, so not very useful. I did the same fits. I fit my own sigmoids and power law plus the periodic. And it was interesting. His sigmoid inflection dates matched the long periodicity of Lambo. It's kind of curious. In physics functionally, we want to try and get a mechanistic understanding of variance structure, symmetry, scaling, those kinds of principles. We don't want to just do statistics. We want to understand. This is a comparison against log periodicity and linear behavior. So the first two are log periodic models, either with 3 modes and 2 modes. And then the next two, the bottom 2 rows, are the best linear with either 3.5 or 3.75 years. The latter is roughly the actual 3.8 year frequency for the halvings on average. And the best linear model had an R squared of 0.21. Again, this is just for the residuals. We found an R squared of 0.48 or 0.53, depending on how many moments we used. We also have these statistical criteria, AIC and BIC, that we supplied, that had much, much better AIC values, better by over 300 and over 400, and got similar root mean square errors. So this is my chart doing the out of sample forecasting, where you only use data up to a certain period and forecast it forward. The pure power law is the blue line, and I'm able to show that the power law fundamental only, but without decay, did not outperform. But once you put the decay in, you get the green line, and it actually outperforms the pure power law. And then if you add a harmonic, it also does well. It actually doesn't improve. It's kind of similar. But from half a year out to 2.5 to 3 years, adding the log periodic out of sample gives better performance than the pure power law, and the AICs are better as well.
Okay. So
Because
that's what you suggested to me in your email correspondence. So thank you for that.
I suggest adding, having the fundamental and having some kind of decay that's roughly a reciprocal plus an offset. And that will be superior from half a year up to about 3 years to power law only. And to half a year, from what Carlos has shown, a naive model out short time scale. But if you add some financial conditions, then maybe you can beat it.
Okay.
These are springback times. There have been 30 crossings above and below the power law, 4.7% null zone where you don't count it unless it moves through the zone. And of course, we always come back, right? So we've got 29 reversion times. The maximum is very long, 871 days. The median is about 60 days. The mean's about 186 days. Well, our low, this is measured from the low, is early June, right? So it might take us half a year, but it might take us longer to get back to how. It is a wide variation. I couldn't find it in correlation, age or log age.
Which today I think sits around the power law trend prices around 142,000.
Right, about 140. Okay, so this is in way of closing. What we're doing here is we're doing physics, we're looking at complexity economics, and we're looking at network economics. These are the things that we're studying at the Scientific Bitcoin Institute. Some suggested reading here, our paper. You can find it on Zenodo, which is the CERN preprint site, and it's been published in Nonlinear Science. I don't know if it's freely available yet, but we are. And then Giovanni's book, I encourage people to read that, The Physics of Bitcoin. It's a thick book with a lot of color pictures, so it's a little bit expensive if you buy it in the soft cover, or you can get the ebook for $10.
Highly recommended. Compliment
Yes.
Giovanni for me, please. I enjoyed it.
And our webpage, scientificbitcoininstitute.org, this shows the different areas we're studying. We're forming relationships with universities, including Politecnico di Torino. We have an office in Torino, and a relationship with a Swiss university and one with a university in Taiwan. And so they bring different skills like in cryptography from the Polytechnic. We're doing work in networking, complex system sciences, monetary economics. We've also looked at game theory, agent theory. We've got a researcher that came out of Rome that's looking at agent modeling. Very interesting work that he did. Mining and energy is also part of what we're interested in. If you go to the Scientific Bitcoin Institute, you can sign up for free and get access to the basic indicators. We're just starting to put these up. This is the Bitcoin power law corridor, and it shows some 1 and 2 sigma bands and how far away we are from the trend. This is using the long-term volatility. The falsification is down at 3 sigma, 17,000. A rough floor, we don't say there's a hard floor, but it's kind of a zone down around 50,000. And you can toggle that between linear chart, log linear chart, and log chart, and even the residuals.
Cool.
We're a nonprofit established in California at the beginning of this year. Giovanni is the director. I'm the vice director. And we have offices in San Diego, Torino, and Bangkok. And we also encourage people to become members. We are defining membership categories. We'll have a minimum. Take any further questions.
Great. Well, one of my questions for you, Stephen, on that point was, what are your hopes in the future for the Scientific Bitcoin Institute?
Right. Well, our goals are research and education. So, of course, we hope to understand Bitcoin's meta network better. And there are so many influences with a dozen networks there. And so researching those various areas that I showed in collaboration with partners. So we want to build that really this focus you have to week because it's a Bitcoin show. This is a European time, most weeks, and other avenues, including on the website. We're producing some training modules on the website, and we've got a bi-weekly newsletter that we're just starting up. So that's going to be available for free for people who sign up. So go to the website, sign up for that. We also are actively looking for corporate sponsorships. We have a principal sponsor who's given us the initial funding that allowed us to get established, but we want to broaden our partnerships with corporations and investment firms as well.
Fantastic. Kevin, do you want to close us off with anything?
Just, Stephen, you put up reference to your Money or Debt newsletter, to which I am a subscriber on Substack, so also highly recommended. Again, your work has been truly inspirational for us in doing what we are doing in agriculture. Just thank you to you. Thank you to Giovanni, and keep on going. All the encouragement we can offer.
Thank you very much for having me on.
Yeah, thanks for coming on, Stephen.